Interestingly, the credit markets have held up a lot better than the energy equity markets right now. So that tells you that credit investors out there believe in the oil story much more so than energy equity investors do right now.
Okay, when you say words like systemic, I get a little nervous. What's the systemic fallout of this?
Well, as I said, a lot of companies are high yield. About 20% of the high yield market is linked to energy companies. So you start to have worries of what goes on there, particularly if the Fed continues to tighten. Now, obviously, that's been something that's called into question as well. So there are a lot of uncertainties on that front. Energy has been a very big contributor to employment in the U.S. It's a big contributor to the U.S. economy. So certainly, consumers, we like lower gasoline prices, but there are broader impacts for the economy as well, as the U.S. is now the largest producer in the world and a net exporter.
These are important issues you're bringing up, something we've talked about. We've said for years, people say, why do you like the oil market so much? It's not that I like the oil market so much, is that this is a debt story. This is an industry that's been built on hard work, sweat equity, but also debt and debt equity. And there's a real risk that these prices at 43, 45 a barrel, a lot of these newer producers are probably deeply cash flow negative.
That is correct. But the interesting thing is that the industry as a whole is in a lot stronger position today than we were in the last price crash of 2014.
Good point. Fair enough.
So a lot of the debt has been put in a much more consolidated position. We just had a round of credit redetermination in the fall when oil prices were higher. So that should buy us some time in the market as well.
You know, and I had somebody tweet at me, I called these oil companies highly levered, and they said, no, these are not highly levered. The balance sheets are great. We're looking out at discounted cash flow analysis. Sure, in the past quarter, they weren't highly levered. But when you start to change all of your assumptions, 45 a barrel for a month, a quarter, maybe a year, we don't know, maybe 30 a barrel, maybe 60. It is very difficult to predict how these balance sheets are going to look, is it not?
Yes, and a lot of companies over the past couple of weeks during this price downturn have announced their capital programs for 2019, and they have said, we are going to cut back spending, we are going to cut back rigs. But the interesting thing is that you've been seeing double-digit percentage declines in CapEx, but you're still seeing double-digit percentage increases in production growth. So production is continuing to grow because of efficiencies, even as spending levels have come down.
But your first point, I think, is the most important, Tamar, from a macro perspective. Even if you don't care about oil and gas, maybe you have solar panels and you drive a Tesla and you could care less. Here's why you care. 10.5 million jobs directly, indirectly in this industry. If capital spending plans get shrunk, and I expect that they are going to dramatically, we're just not going to do that project. We just don't know if we have the cash. That's going to hurt jobs. It's going to hurt sales and across all kinds of things.
Absolutely. Yeah. Yeah, and I mean, that's the interesting thing. The oil markets are cyclical, so the cure for low prices is low prices, but unfortunately, it does take time. So lower spending levels will ultimately result in a slower pace of growth, but there's that lag time between when you spud a rig and when there's actual oil sales. So we talk about shale as being fast cycle, and certainly it is faster cycle relative to conventional deep water and offshore wells that take years to build and to come online. But relative, let's say, to Saudi Arabia, that can turn oil production up or down with basically a flip of a switch, it's not that way. There still is that 6 to 9 month lag time between when you see lower prices start to materialize in actual lower production.
Not that hard.